No, I said, I thought you were talking. I can do it. I can do it.
Okay, folks, we're in the mopping up stage of this class. We have only 3 sessions left after this one. So next week, and of course, the Monday after. The last day of class is the day your project is due. It doesn't have to be due in class. Now, obviously, it's a project report. It's a PDF. I mean, try to send it in as a PDF file, even if you make it as a PowerPoint or a Word. Send it in as a PDF file because I can put in comments easier into a PDF file than into Word or PowerPoint. It makes my life a little easier. So that's on May 9th. Your final exam is 2 days later. So it's about as early as it can get, first day of the final exams week. Now you'll have to check the times. There are it's an hour and 50. I think 2 hours, but no, it doesn't exactly match up to the class time. So it's around the class time. So check to see what the times are, and I'll send you a reminder of the time later. And any questions before we start? Your quiz 3s are upstairs if you want to pick them up. And, I send the distribution. I don't know whether a distribution even helps because remember the worst quiz gets dropped. So in a sense, I was going to send a cumulative distribution, but even that doesn't make any sense because not all 3 quizzes count. So, take it for whatever it's worth that, whatever that distribution tells you. But let's talk about, it's built on this theme of the option to delay. Now, let's see how much that patent discussion last week registered. Let's assume, so the start of the class test, let's assume you have come up with this new technology. It's a smartphone technology. It speeds up download, smoother interface. You do the projected cash flows. You estimate that the projected cash flows from developing this technology today is only $1.5 billion. It'll cost you $1 billion to actually commercialize the technology. So if I asked you, would you develop the technology today? What's the answer going to be? No, it's a negative net present value investment. But let's assume that you worked at one of the existing cell phone manufacturers. It can be Apple, it can be Samsung. Would you pay for the rights to this non-viable technology? It's technology right now is not viable, but it could really help. Would you pay for the rights for this technology, assuming that the company that's come up with it has patented it, and there are multiple years left on the patent? What's the answer? And coming from the patent discussion, remember, just because a technology is not viable doesn't mean the rights to that technology are not valuable. Yeah, you'd pay for it. So I want to ask a few questions about how much you would pay for it as a function of that technology. First, would you pay more or less as the number of years left? So if I have 15 years left on my patent as opposed to 5 years, you'd obviously pay more. Why? Because an option with a longer life is. What about higher uncertainty about how smartphone technologies are going to evolve? Here's where having an option makes a difference, right? Normally, it's at risk is not good for me, but here it's going to help you. It's non-viable technology. You want the underlying business to be uncertain because that's what will potentially make it viable. One final point. Now, let's say you do buy the technology, and at some point in time, 2 years from now, 3 years from now, the technology becomes viable. Basically, the present value of the cash flows exceeds the initial investment. It's a positive net present value project. You still have 13 years left on the patent. Would you develop the technology immediately? That's a question I'm asking. Would you exercise the option the minute it goes in the money? What's the trade-off you're going to weigh? One is by developing it immediately, you start getting the cash flows right away. What do you give up? No, you basically give up the fact that if you waited a year, maybe you could learn more about the technology, make it a better technology for the phone. This is a choice technology companies face all the time. Should you rush technology to the market the minute it becomes viable and then risk other people copying your technology, or do you want to make it even better before you hit the market? No. I don't know the answer to that because it really will depend on what you give up by waiting that extra year. And if you feel that what you give up by waiting the extra year is going to be too much, you're going to develop the technology. And the closer you get to your end of your patent life, the more likely you're going to get triggered to develop the technology. It's what you saw with that Avanex patent as you got further and further towards expiration. So it does change the way. And that's, I think, part of what I wanted to take out of real options is even if you never, even if you never use real options in, actually to value something, it'll still change the way we think about projects, we think about, how to invest. And that, I think, is why this entire discussion is useful no matter where you go to work. So let's go back to that patent that we valued. Remember, there's a three-part test. Let's take a patent through the three-part test to see if it passes the real options test. Is there an option? Yeah, clearly there is an option to develop the patent. What's the contingency? The present value of the cash flows from developing the patent exceed the cost of developing it. It's an in-the-money option, so there is a contingency. So clearly it passes the option test. Is there significant economic value? What's that answer? What answers that question? What are we looking for? Is there exclusivity, right? With a patent, there is, and it comes from the legal system, which also means that if a legal system doesn't enforce patents, the value of the option can very quickly dissipate. And finally, can you use an option pricing model? We're really stretching the limits of an option pricing model. And think of what? Option pricing is built on replication and arbitrage. You got to be able to trade the underlying asset and trade the patent. In this case, you can't trade the patent. You can't trade the underlying product. This is about as far as you get from the assumptions you would need. So the way I think about it is when you use an option pricing model for Avanex, I used to come up with 907 million. It's going to be very difficult to monetize it, which means if you're bargaining with somebody to sell this, don't expect them to pay 907 million because they're going to say 650 million, take it or leave it. And you might have to take the 650 million because you don't have the alternative saying, let me go out and monetize this option myself. So option pricing models might give you an indicator. You can try to negotiate for it, but you're not in a very strong bargaining position because the potential buyer is going to say, how are you going to monetize this option? Sorry, a question, or is your mic just on? Let's take a second example where the option to delay comes in. You take oil companies, gold mining companies, any commodity company. There are two areas when you look at a company. There's developed reserves, which they extract oil or gold or coal or whatever they extract, and they sell it, which is a traditional discounted cash flow asset. But every commodity company also has undeveloped reserves. They have the right to develop these reserves. Keyword is right. They're not under an obligation. Let's set up the optionality there. Let's assume the cost of developing these reserves is X dollars. So this is the cost of putting the rig up, whatever you need to do. And let's say the present value of the cash flows you would get from developing these reserves is V. So if you think of it in terms of option pricing, if V is greater than X, you will develop the reserves. If V is less than X, you will sit and hope that what happens? Oil prices go up, gold prices go up, iron ore prices go up. It's an option, and actually the payoff diagram looks very simple. The cost of developing the reserve becomes the strike price. The oil under the ground becomes the underlying asset. The value of that oil is what's going to determine whether you exercise or develop this reserve. And if you do develop the reserve, it's because the value of oil exceeds the cost to make the difference. But again, you could be disappointed, right? Oil prices could drop and stay down for the next 15 years, and you paid for these reserves and they never become viable. In which case, what do you lose? You lose whatever you paid to get these reserves, which can either be exploration costs, if you're an oil company, analogous to R&D expenses, or many reserves are actually bought at auctions. Governments auction off reserves, whatever you paid for these reserves. So let's put some teeth behind that picture. It's abstract. Let's again try to convert what we talked about into actual inputs in an option pricing model. So you have undeveloped, let's make this undeveloped oil reserves. Right? Let's go item by item. What's the S? The S is what you would get if you develop the reserve today. With all option pricing, keep that in mind. This is what you would get if you develop the reserve today. So what will that mean? You take the oil you expect to develop over time. You'll use today's oil prices because you're not clairvoyant. You can't forecast what oil price will come up with. You come with the present value of the cash flows. That becomes the S in the model. If you look at the K, it is the cost of developing the reserve. Now, how much is that going to be? It's going to depend on where in the world these reserves are. If they're in Saudi Arabia, it might be close to nothing because the oil is so easy to extract. If you're in the northern reaches of Canada, you actually have to go down 5,000 feet, fight through frozen land to get there. It might be $50, $500, $5,000, depends on how deep down it is. The cost of developing the reserve will vary depending on where the reserves are. And you have a history. ExxonMobil knows roughly how much it costs to develop reserves in the Gulf of Mexico as opposed to the Canadian wilderlands. The time to expiration, this is tricky. Because when you buy reserves from a government, you don't get them in perpetuity. You get them for a finite period. So right now, the US government has suspended bidding on oil reserves in the US. I mean, this was the last few months. But before that, you'd bid in the auction and you'd get the rights to develop whatever reserve you bid for, North Dakota shale oil reserves, for the next 20 years. At the end of 20 years, it reverts back to the government. That becomes the time to expiration of the option. Here, though, what's the uncertainty? There are two things. One is you don't know exactly how many barrels of oil there are under the ground. You have these geologists who tell you there are 100 million barrels. They could be wrong, but they're actually pretty close to the right answer. But the real uncertainty here doesn't come from how much reserves you think there are, but from the price of oil. The variance in the underlying asset here is the variance in oil prices, because that's what's going to drive the value up and down. And there are two final loose ends to tie. The first is, once these reserves become viable, and let's face it, at $90 a barrel, a lot of reserves that looked non-viable 2 years ago are now looking viable. If you choose not to develop these reserves, you give up the cash flows you could get in the next year, the next 2 years. But by waiting, maybe oil price will go to $150. This is always every commodity company's question, right? Should we wait for prices to go up even more? Because you can't develop a reserve and then put it back in the undeveloped part. It's too expensive to actually invest the money, open a reserve, and then shut it down again. So this choice then binds you to whatever happens over the next 15, next 20 years. So that's the first thing that becomes like a dividend yield. Once a reserve becomes viable, if you choose not to develop it, you leave the cash flows away. And that's essentially the equivalent of a dividend yield. And there's one final practical aspect here. And as I said, oil prices have gone up close to $100 a barrel. Let's say US ExxonMobil or Royal Dutch or Chevron decide you want to develop the reserves because oil prices are high. You pick up the phone or whatever communication device you have. You call your engineers and say, develop the reserves. Does oil start coming out of the ground tomorrow? Hey, there's a whole sequence of events, infrastructure has to be put in. And if you're lucky, maybe 2 years from now, oil will start to come out of the ground. Do you see how this exposes you to risk? You made this decision to develop the reserves because oil prices are $100 a barrel. By the time the oil comes out of the ground, it might be back down to 35. You can partially protect yourself against this using futures and options, but only partially. It's called a development lag. Basically, what that means is there's a time lag between the time you decide to exercise this option and actually getting the cash flows out. You don't have that lag when you exercise a listed option, right? You get online and you say, I'm going to exercise the option. The cash is in your account in 5 or 10 minutes. Oil reserves and commodity price reserves, you have this practical element of waiting. So I'm going to try to bring them all into play in an acquisition from way back in time. And I'll tell you why I've stuck with this example, even though I could use a more updated example. A company called Gulf Oil, in the early 1980s, was targeted in a hostile acquisition. It had 165.3 million shares outstanding, and an acquirer was offering to pay $70 per share. And the main driver in this acquisition was that Gulf Oil had a huge undeveloped reserve, 3.038 billion barrels of oil in undeveloped reserves. The cost of developing these reserves was estimated to be about $10 a barrel. So if you developed all these reserves today, it would cost you $30.38 billion to develop these reserves. So let's look at the rest of the information. What is the price of oil? At the time that I did this, the price of oil was $22.38 a barrel. So early 80s. The variable cost of getting the oil out of the ground was $7. So if I paused right there, that's about $15.38 per barrel of oil that you get out of the ground. And there are 3,038 million barrels. You have 12 years on average life left on these reserves. So basically the rights you have to develop these reserves will run out on average. But why on average? Because you have reserves all over the world, some 3, some 5, some 7. I've just taken a weighted average. And to complete the story here, the T-bond rate at the time that I did this was 9%. Shows you how long ago it was. This was the 10-year US Treasury bond rate was at 9%. And if Gulf decides to develop these reserves, after all, if they're viable, you could develop them, it'll get cash flows that amount to about 5% of the value of the reserves. So each year that these reserves are actually running, you're going to get cash flows that amount to 5%. I have everything I need to value this option. And the final piece of information I'm going to give you is the variance in oil prices is 0.03. What's your first reaction when you look at 0.03? It looks really low, right? Be very careful, variance numbers in decimals. And here's why. If you have a standard deviation of 20%, if I converted standard deviation decimals, it's 0.2, right? If I convert the standard deviation of variance, you just square the numbers. 20% squared is 400%. If I take 0.2, which is the standard deviation, and square it, you know what I'm going to get? I'm going to get 0.04. 0.03 looks low, but it's like a 15% standard deviation playing out in variance stuff. So oil prices are volatile. So I'm going to try to value this option or the reserves as an option. So the first question asked is, if I develop all of these reserves today, all 3,038 million barrels, and to make my life simple, I'm going to act like I take all of the oil out right away at that $15.38 a barrel. If I wanted to do this right, I'd have to figure out what the capacity of production is. Maybe it's only 200 million barrels. Take it over 15 years, project out an expected price based on futures prices, and take the present value of the cash flows. I've taken a shortcut. The present value of the cash flows from developing these reserves today is 42.38 billion. So that's how much the value of the oil under the ground is. It'll cost 30.38 billion to develop these reserves. So if I stopped right there and said, from a discounted cash flow perspective, what is the value of these undeveloped reserves? It's going to be 42.38 minus 30.38 or $12 billion. So in a traditional DCF world, the value I would attach to these reserves is $12 billion. But remember, I haven't developed these reserves yet. There's 12 years left on the option. The variance in oil prices is 0.03. The T-bond rate is 9%. And each year that I wait to develop these reserves, after all these reserves are already viable, I'm going to leave some cash flows, which in this case is 5%. You plug the numbers in N of D1, N of D2. Remind me again what N of D2 is. We said N of D2 can be read as
Probability.
the probability that S will be greater than K, right? Which is in this case that the value of the oil, there's an 85.4% chance these reserves will be developed. No surprise here because they're viable. And if you look at the value that I get for the option, the value that I get for the option is 13.3 billion. What was the DCF value? 12 billion. Where's the extra? This is like magic. I've taken a $12 billion value and I've added an extra 1.3 billion. Where's that value coming from? It's coming from the fact that there's optionality. Remember, I said options allow you to add a premium on DCF. That's the extra option. If I take the variance of 3%, 0.03, and make it 0.05, in other words, oil prices become more volatile, you know what's going to happen to this? Even if the price doesn't change, the value of the reserves will go up because the optionality increases. The value of an oil company is a function of not just the level of oil prices, but the variance in that level. Because if you have volatile oil prices, your undeveloped reserves get more option value. So I'm ready to complete this process. Gulf Oil had developed reserves as well, on which they were expecting cash flows of $915 million. Again, I'm going to keep my life simple. They had about, in this case, about 10 years of reserves left. I took the present value of $915 million every year for the next 10 years. Obviously, this would be messier if you actually put in a growth rate, but essentially that's the present value of developed reserves. That's about $5.065 billion. The value of the developed reserves is $5.065 billion. The value of the undeveloped reserves is $13.3 billion. You add those numbers up, you get a value for Gulf Oil of $18.4 billion. And then you can do subtract that, add cash, do whatever you do in a DCF. It's an alternative to the way we traditionally value natural resource companies. We project the overall cash flows, we take the present value. This breaks a natural resource company into two parts: developed reserves and undeveloped reserves. Treats the developed reserves like a traditional discounted cash flow valuation, but then treats the undeveloped reserves separately because they're a function, not just at the level of prices, but the variance. I mean, 2 years ago when oil prices hit $30 a barrel, if you did a discounted cash flow valuation of almost any oil company in the world other than Aramco, you'd have concluded that you should never touch another oil company again. Right? If you take the $30 and you make that your futures price and you project out cash flows. Now, of course, you could try to bring in oil price views into your valuation, but that, as I said, is dangerous. But if you valued those reserves as options, you would still be buying these companies. And in fact, you'd be disproportionately buying companies which have lots of undeveloped reserves. You'd pick up Petrobras over an ExxonMobil because Petrobras gets more of its value from its undeveloped reserves. So that's a natural resource option. That's the option to delay. The option that really excites these real options people is the option to expand. Because what it allows you to do is override all those things you were taught not to do or taught to do in corporate finance. Don't take negative net present value projects. Let's take that and see why the option to expand can change the decision. You have a project which has a negative net present value. The rule still says the same, don't take the project. But what if by taking that negative net present value project, you get a chance, a right to take on other projects? In other words, the first negative net present value project opens the door to other projects you can take, an option to expand. Right now, that option is not viable. You would not do it today. Otherwise, you'd just go into the big investment right away. But if things work out in the initial project, in other words, your cash flows come in higher than expected, then the option to expand becomes valuable. So you have two projects kind of locked at the hip. The first project is a negative net present value, so no optionality here. But the second project, the option to expand, takes on the characteristics of an option. So let's again draw it in terms of a payoff diagram. So right now you're taking a project and you're thinking about, should I expand? You can expand any time over the next 5 years. Let's put 5 years as a level. If you decide to expand, the cost of expansion becomes the equivalent of your strike price. You will expand if the present value of the cash flows from expanding exceed the cost of expansion. And as with any option, you could be disappointed. 5 years from now, you could say, I should never have taken that first project. It didn't work out. I told you that this is actually one of the reasons companies like to go into markets like India or China or any large market, even if they know on their initial investment they're going to lose money, because that option to expand can be so valuable. So I'm going to use a very simple discounted cash flow model analogy to illustrate this process. Let's suppose I come to you with a software company. I produce security software. You do a traditional discounted cash flow valuation, growth, margins, reinvestment. you come up with the value of $115 million. You'd be done, right? That's the intrinsic value of the company. But here's where the optionality kicks in. Because this company has security software, it's collecting information from its users about what kind of threats they face. And over time, if you think about the database of threats, they're not looking forward. They think they can produce a database software program that they can sell to customers. And I'll give you the details of what this program would cost. It would cost them another $500 million to produce this database software program. And based on what they know today, the expected cash flows from that software program are going to be $40 million a year for 10 years. Without even doing present value, you can see this right now, it's not a great investment, right? $500 million upfront, even without discounting, 40 million times 10 is 400 million. It's not going to be a good investment. In fact, if you add the cost of capital at 12%, the present value that you get of 40 million a year is 226 million. So right now, this new software that they could potentially create has a negative net present value of minus 274 million. So near DCF, you wouldn't even show. It's not viable. But the market is very unstable. There's a lot of uncertainty. In fact, let's assume that the standard deviation in database software firms or projects is 50%. So that 226 million could change dramatically over time. You have 5 years over which you got to make this decision. And that might seem arbitrary, but companies face this choice of you either fish or you cut bait. Basically, you can't sit there forever waiting to make a decision. So by the end of the 5th year, they have to decide whether to produce this program or not. And the riskless rate is 3%. Again, we're going to pull up some sleight of hand magic. You plug in the numbers, SKRT, and sigma, the value that you get for this option to produce a database software program is $56 million. Think about it. This is a project with a negative net present value of minus 280 million, horrifically bad project. But because there's a lot of uncertainty, the option to take this project is worth 56 million. How much should I pay for this company? Assuming this database software information I've used is reasonably correct, I'd pay the 115 million DCF value plus the 56 million option value to come up with the value of 171 million. Now, right now, there's all this talk about you buy platforms. People want to buy platforms of users, platforms of subscribers. In fact, there's an open debate about, should Amazon buy Peloton or, because Peloton, its current market cap looks attractive. Now, Peloton as a business, you might look and say, look, I'm not going to make enough in cash flows to cover the price. And let's say your DCF comes in with a value lower than the price. You could argue the same thing about Twitter, right? 30 million users. You could come up with the value, and the value might be lower than the $54.20 that Elon Musk is paying for it. But you are getting a platform with 330 million users, 200 million of whom are pretty active on the platform. Right now, Twitter can't figure out a way to make additional money of these users. There's talk of subscriptions, but it's not kind of found ground. But you could argue there might be something you can do. After all, you are where news breaks. You become the platform. Maybe you can create a way in which you can monetize. Let's say you do the present value of doing that right now, and you conclude it doesn't make sense right now. But you could do it next year, 2 years from now. What gives you exclusivity? The fact that these users are on your platform. You can't just create this out of nothing. There's an option, which means whatever you get out as your discounted cash flow value. And I think last week when I valued Twitter, I came up with $45 per share. You can argue that there's an option value on top of that. We can argue how much that option value is, but you can very quickly see why even if Elon Musk does nothing right now, at $54.20, he might be getting at least a fairly valued company and perhaps even an undervalued company. I know it opens this door for people paying these immense prices for platforms, so we now know what questions to ask about how much additional value. Where's the exclusivity? What are the other things we can do? Yeah. In fact, I think somebody in this class is doing Moderna. Is Alex here? Oh, yeah, I can't even recognize. She's doing Moderna, and she emailed me yesterday. And tell me what your question is.
The Moderna is in
Is that patent, in fact, I'm not clear on this, is that patent on the mRNA technology or is it on the vaccine?
I think it's specifically on the vaccine.
Okay. But,
Also,
okay.
dispute with the technology.
On the vaccine, it's more downside than upside, right? Because there's no benefit you get from it. But the mRNA technology itself potentially could be used in dozens of other places. Right now, people haven't figured out where else you could use it. You could argue that Moderna gets close to fairly valued. You should be buying it because you're valuing it based on the vaccine and the cash flows, and you can bring in the risk that the NIH may take away. But he's saying, I'm getting this icing on top of the cake from the optionality. It's a reason, in spite of Facebook's many faults, and it has lots of issues. I'm inclined to buy Facebook. Forget about it being undervalued. If it gets close to value, it's simply because 2.9 billion people on your platform an hour every day. Right now, all you do is sell them advertising. Right now, it might not make sense for you to retail to them or provide them entertainment, but what if you could figure out a way to do that? That would be an incredibly valuable upside. So again, that's the options argument. The option to expand can make you pay a premium on top of some of these companies with really big platforms of users, subscribers, members. Now, of course, you got to be skeptical when people make this option to expand argument. Often they're trying to get you to pay for a platform, trying to get you to enter a big market. And here are some of the questions you need to push back with. Remember, I've got two investments latched up. I want you to take this negative net present value investment in order to get that positive net present value investment. So the first question I'm going to ask you is, do I have to take that first investment? Is there a way for me to enter China directly without having this first investment where I know I'm going to lose money? Is there a way that I can retail to people online without buying a platform of 250 million users? The answer might be no. But you need to make sure that you're not connecting to investments that don't have to be connected. In the 1990s, a lot of people argued that you should pay a premium for .com retailers because you got the option to be in the e-commerce market. That's a very weak argument because at that time, you could get on the e-commerce market without being a .com company, without paying a premium. The platform companies, I think you have a stronger argument because the users are attached to platforms, and without the platform, you might not be able to get those users. So the first investment need. For the second, where does the exclusivity come from? What are the competitive advantages? If you have users like Facebook does who are attached to your platform on there for an hour every day, that's a very strong competitive advantage. If you have a platform where people come and go and they're not particularly loyal, might not be that valuable. So you might want to ask questions about not just how many users are in your platform, but how long do they stay? It's called the intensity measure. What's the retention ratio? And that's why in the last few years, many user-based companies have had to report daily active users and not just total users, because there are a lot of people. I'm on a lot of platforms I haven't visited in 7 years, 6 years, 5 years, because let's face it, everybody wants to put you on a platform, right? You go buy at Home Depot. They're putting you on a platform. The fact is, it's a completely useless platform because I have absolutely no loyalty to it. It's not like I'm saying, I need to buy at Home Depot. I'm on the platform. If Lowe's is cheaper, I'll go to Lowe's instead. So it allows us to ask the right questions to gauge what the optionality is in the platform. So let's ask the real options, the test for, is there an option? Yes, it's the second project, the expansion project, that's the option. The contingency is the present value of the cash flows from expanding. Adding retail to the Facebook is greater than the cost of creating that service, you're going to do it. So clearly there's an option. Is there exclusivity? It depends. With Facebook, I think there is strong exclusivity because WhatsApp plus Instagram plus Facebook create this attachment to a platform. But with a company where people come and go, with Uber, I'm not sure you get that same degree of attachment because I'm on Uber, I'm on Lyft, and if a third ride-sharing company came along, I'm probably not going to be particularly attached to the first two. In fact, one of the things I talk about with young business is creating stickiness in platforms. What is it that you're creating that makes your users sticky, that they stay on your platform? So if you're ever starting a business that's platform-based, that's one of the ingredients you need to think about creating the optionality. And finally, in terms of the pricing test, again, we're pushing the limits of option pricing models. With the example that I just gave, you can't trade the option to expand. You can't trade the underlying project. Nothing is tradable. And we're using replication and arbitrage. So again, get those values. The 56 million that you saw there could be 35, it could be 90. So in practice, I actually almost never, so when I bought Facebook the first time and I bought it based on the options argument because it's close to fairly value and I'm getting this option, I didn't actually try to put a number on it. I just said it's big. I don't know how big. And because I'm getting it at fair value, this is all upside for me. I'd be very, very, very skeptical about if you told me to buy something that's 30% overvalued. Then said there's an option there. Don't worry about the 30%. Which is what a lot of people are doing. They're using the options argument to overpay for companies without thinking through whether the option has significant value or very little value. Any questions on the option to expand? Let's talk about the option to abandon. Most real options we run into are call options. If you think about it, the undeveloped reserves, the patent, the option to expand are call options. The option to abandon is a put option. The option to abandon allows you to walk away from an investment if the present value of the cash flows drop below an amount you could get by liquidating a project. So think of what you get by liquidating a project or stopping a project as the exercise price. If the present value of the cash flows drop below it, you're going to say, look, this isn't worth it. I'm just going to shut the project down, sell off the real estate. So let's make this really, let's create a real example. Airbus, of course, is one of the two giants in the aircraft business with Boeing. Lear Aircraft makes executive jets, smaller jets. But let's say you work at Lear and I'm Airbus, and you really, really want to enter the commercial jet space. So you want to make a small commercial plane. You don't have the capacity to do it, so you approach me and seek out a joint venture. You're going to put up half the money. I'm going to put up half the money. Each of us is going to put up 500 million. So as Airbus, I say, okay, let me think about it. I project out the cash flows from producing this aircraft. I come back with a present value of cash flows of 480 million. If I stop right there, I've already concluded this is a negative net present value investment. I've got to invest 500. I'm getting back 480. So I tell you, no, I'm not interested. But you really, really, really want me to be a joint venture partner. So you come back with a counteroffer. You say, look, if you become a joint venture partner, anytime over the next 5 years, if you change your mind, I'll buy out your 50% right for 400 million. You'll often see these in joint ventures where one side, especially the side that really wants the joint venture to go, will offer the other side. Basically, what have I offered? If you're Airbus, I've offered you a floor on your losses, right? You invest 500 million. I said, look, even things go bad, you can't lose more than 100 million because I'll buy you up. I've given you a put option. I've given you a chance to walk away. So let's see, because remember your net present value was minus 20 million before I made this. Let's see how much this put option is worth to you. And to do that, let's assume I've done a Monte Carlo simulation of the cash flows and come up with a variance in the cash flows of 0.16. And the project itself has a life of 30 years. You're saying, why don't you give the option to abandon for the next 30 years? Don't ever do that. Because you know what's going to happen? Even this is a great project. I'll be your partner for 29 years and 364 days. And one day before the project ends, I'm going to show up and say, hey, you promised me 400 million for walking away. So if you're going to give an option to abandon, it's got to end well before the project ends. So here's what the numbers look like. The present value of the cash flows here is 480 million. The strike price is 400 million because that's what you get if you walk away. Variance is 0.16. The life of the option is the period that you get the right to walk away. It's not 30 years, it's only 5 years. But remember, this is a finite life project. What does that mean? Next year, there'll be only 29 years of cash flows left. 2 years from now, 28. So it's almost designed to decline in value every year because you have few years of cash flows left. So the equivalent of the dividend yield is how much I will lose if I wait 1 year, 2 years, 3 years, because each year the project is getting less valuable. And finally, the riskless rate is 6%. Again, if you plug the numbers in and you come up with an option pricing value, and again, with Black-Scholes, you can value both calls and puts. The value that I get for this put is about 73 million. Basically, the net present value is minus 20 million, but I gave you this put option with the value of 73 million. Doesn't guarantee that I'll go along, but it makes it more likely that I'll be a joint venture partner. You know what you have to worry about if you're the one who gave me the option? You wanted me to be a partner. You've given away something that's worth 73 million. Your net present value be well above 73 million, so you can go around giving away these options. This is why you should never let salespeople make promises to customers, right? They would say, I'll buy your product back, because why? They want to get the sale done. They're giving away put options to people, and the company then faces the cost, and that could very well wipe out whatever you got from the sale in the first place. So that's the option to abandon. You can see why it has value, especially when you have big investments, big infrastructure investments. In fact, the implications here is having the option to walk away will actually make it more likely that you will enter these long-term investments, which have potentially very large cash flows over time, because at least you now know that there's an escape hatch. Now, one of the problems I often have with companies is they feel building escape hatches is a sign of weakness. So look, I have so much conviction in this project. I'm going to go 30 years and I'm going to show you how convinced I am by not having any. That doesn't make any sense to me. If you have a 30-year project, you want to have escape hatches. Those are options to abandon. By having those escape hatches, you've essentially made this project a better project. And it shows up in the decisions you make as a company as well, right? So if you're a company, this is an argument for more flexibility in your costs, because that essentially is a way in which you can reduce the cost of staying in the project. It also means that you enter fewer long-term contracts. So if a potential customer says, look, I'm entering, I'm willing to enter a 30-year contract, even though you might feel the urge, let's lock that down, you might go with a 5-year contract, because that 30-year contract might bind your hands and make you stay in this project, even if things are not working. So that's the option to abandon. I'm going to take a little tangent here and talk a little bit about something we talked about in corporate finance, or should have talked about in corporate finance, which is the capital structure decision. Capital structure decision, of course, you look at the actual debt ratio company has, and then you ask, what's the optimal debt ratio for this company? How much can it go? And often that decision is based on, can I lower the cost of capital? And when you make the decision, you could conclude that your company has excess debt capacity. And again, in the corporate finance world, we push towards the optimal. We say, you're under-levered, your cost of capital is too high, move towards the optimal. But there's an argument that in capital structure, you might want to hold back from getting to the optimal. It's an options argument, because many of the options you run in, the other options you run in the capital structure, in the design of securities. You know what I mean by, if you have convertible bonds, you built an option into your bond. So, or even with, if you have a floating rate bond, you put caps and floors on bonds. Those are options. I'm not going to talk about those options. I want to talk specifically about why companies might choose to stay under level. So to understand this option, let's step back. You're a company, you can be at 40%, but you choose to stop at 15%, even though your cost of capital is high. You're saying, why would I want to do that? By having that excess debt capacity, you're creating the option to be able to take an investment that comes along, that is incredible investment, but you now have the capacity to do it. In other words, having excess debt capacity allows you to take big projects that it might be an acquisition. Because you have excess debt capacity, you can go out and borrow the money to do the acquisition. It's a very difficult payoff diagram to draw, but I'm going to try it anyway. So to understand this diagram, think about any traditional operating company. There's a certain amount of reinvestment needs you can forecast, right? Based on your history, you can say, look, my reinvestment needs for next year, 2 years from now. So we do this in DCF all the time. We projected expected reinvestment needs. And most companies also have a normal capacity to raise financing from short-term debt, long-term debt, they have bank loans. So they say, this is how much I raise from normal financing. If your actual reinvestment needs happen to be much greater than what you projected early on, Now, normally you wouldn't be able to take those projects, right? Because you're saying that's a great project, but I can't cover that with my normal financing. But if you have excess debt capacity, here's what you do. You now borrow with that debt capacity and you take that great project. The option here is the option to take a great project that comes from your capacity to use your excess debt to take the project. There are weak links in this argument that we'll come back and test, because if you accept this argument, every company should be underlevered, right? Because having that excess debt capacity goes, means you can go out and take projects. Now, of course, when you take a project, the value of that project comes from the net present value of that project. So if you think about good projects, so having excess capacity to take zero net present value projects is kind of silly. You want excess debt capacity because you want to take good projects. It's a very messy option, and I'm going to try, though, to do this with an assessment that I did for Disney, perhaps the first edition of my book. Of course, if you're taking corporate finance now, you're in the fourth edition, the numbers have shifted. But this, I think, was 1997. Disney's actual debt ratio was 18%. Now, the way we decide what the optimal debt ratio for a company is we look at the cost of equity and the cost of debt at every debt ratio, and we see where the cost of capital is minimized. So if you look at the existing debt ratio, the cost of capital is 12.22%, but if they move to a 40% debt ratio, they could be at 11.64%. So in a corporate finance class, you say you should move to the 40% debt ratio, your cost of capital decreases, your value goes up, and then you move on. But the company is clearly underlevered. But let's say Disney pushes back and says, look, we're going to stay at 18% because we want that excess debt capacity in case we have to do a big acquisition, take a big project. Let's value that option. And we're going to measure the value of the option in annual terms so we can see whether it's greater or lesser than 58 basis points. You're saying, where did the 58 basis points come from? That's a difference between the 12.22 and the, so think of that as the cost you're bearing right now by being underlevered. So let's say the value of the option is greater. And to do this, here's what I did. I went and looked at what the reinvestment needs were at Disney as a percentage of value each year. So I took net capex and change in working capital, divided by the value each year, and I did this over time. What was I saying? How much uncertainty, how much volatility was there in that number? So that reinvestment is 5.3%, and the variance in that number was 0.375. So on average, the reinvestment at Disney is about 5.3% of value, but there's a lot of variation around the number. Some years it's 9, some years it's 1. On average, it's 5.3. In a typical year, Disney's raising new debt and equity. So this is primarily new debt, not even new equity. And retained earnings of about 4.8% of value. So again, every year I went back and looked at retained earnings and new debt, and I took it as a percent of value. So 5.3% is their expected reinvestment need with a lot of uncertainty. 4.8% is what they can raise. I'm going to value this option on an annual basis because I want to see whether it's greater than 58 basis points or less than 58 basis points. What I got as the value of this option was 1.6092%. But before you get too excited, that's the value of taking a project. But the project's value comes from its capacity to earn more than its cost of capital. See, what's the final piece? At the time that I did this, Disney's return on capital was about 18.69%. If you assume that the new project it can take with the excess debt capacity has exactly the same returns, Disney is making 6.4% more than expected on an annual basis. This option with that excess return built in was 0.85%. Long story short here, if these numbers hold, the value of flexibility to Disney from having excess debt capacity is 0.85%. The cost to Disney of having this excess debt capacity is 0.58%. So if Disney's board said, look, we're not borrowing more money because we need the flexibility, at least it looks like they have a basis for it. But let's dig a little deeper to see why you're going to give license to some companies to stay under level, and why in other companies you're not going to accept this argument. So let's look at the drivers of this option value. First, when I argue that I need excess debt capacity to be able to take that great project, I'm implicitly also telling you something about capital constraints, right? If I lived in a world where I could go out and raise as much capital as I wanted, whenever I wanted, There's no argument for keeping excess debt capacity. I should go to the 40%. If a new project comes along, what should I do? I should go out and raise fresh capital. So I'm already willing to make a couple of statements about what kinds of companies should stay under level. First, companies which have significantly, if you look at in terms of operating cash flows, with large internal operating cash flows should value flexibility less than companies that don't. Why? Because you have a lot of internal operating cash flows. You don't need to draw on excess debt. You should be able to use those. Second, companies with easy access to capital markets should value financial flexibility less than companies without that access. So if I have two companies, one is a large market cap company, $1 trillion company, the other is a $10 billion company. I'm willing to accept the argument from the $10 billion company that they need to stay under level much more easily than the $1 trillion company. If Google says we're under level because we need financial flexibility, I'm going to laugh. We say, really? You're a $2 trillion company, you can't raise capital. You have lots of internal cash flows. Emerging market companies, I would actually argue, should be more under-levered than developed market companies. Why? Because your capital markets, if you're an Argentine company, for God's sakes, don't go to your optimal debt ratio. Hang back. Who knows what next year will bring? So that's the first factor. Second, it'll depend on how unpredictable your reinvestment needs are. Remember for Disney, I made my reinvestment needs were 5.3%. If I made the standard deviation 0, what does that mean for Disney? Every year, your reinvestment needs are going to be 5.3%. If that happens, the value of the option will very quickly dissipate. Why? Because if you know exactly what your reinvestment needs are going to be every year, you can plan for it. You don't need to set aside excess debt capacity because you know what's coming down the pipe. So businesses which are riskier, technology companies, a small technology company, should be more under-levered than a small food processing company because your reinvestment needs are less predictable. And third, this is about not just taking projects, but taking good projects. Remember that graph I showed you was 60% of companies around the world have trouble earning their cost of capital. If you're a company that has had trouble making your cost of capital every year for the last 15, and you have excess debt capacity, don't even bring up financial flexibility as an argument. It's not going to go very far. Because you say, look, I need excess debt to do what? To take more bad projects? Why would I want you to have that? I'm going to push you to borrow more money if you're in a business where good projects are tougher to find. Now, the reason I make such a big deal about financial flexibility, this is the primary reason that many hostile acquirers use for acquiring mature companies. You have excess debt capacity. And in some cases, it's clearly right. In some cases, it's shaky. And looking at these characteristics might let you determine when Carl Icahn is on solid ground pushing for more debt and when he's pushing where he shouldn't be pushing, where it really makes sense for the company to be under-levered. Conversely, if you're in my corporate finance class and you find a company under-levered, you're saying, how do I explain it? Look at the factors that drive financial flexibility because that might explain why your company is hanging back. Which brings me to my final case where we're going to use options. Now, when you have equity in a publicly traded company, there are two characteristics that drive your equity holding. The first is you're in control of the company. If you wanted to, you can liquidate the company anytime you want. The second is you have limited liability, which means the most you can lose is what you paid for the shares. Those two characteristics of equity in a publicly traded company give it the characteristics of a call option. Let me explain. You run the company, you own the equity in the company. If you decide to liquidate the company, this is an option to liquidate. You can liquidate, pay off the face value of the debt. If the value of the assets exceed the face value of the debt, you keep the difference. And if that's not the case, you lose what you originally, that's the limited liability part, that you can't lose what you pay. I know just a picture, but I'm going to use this to extract maximum mileage out of it. So I'm going to give you a very simplistic example. And I'm going to let you play two different roles. And to set this example up, you guys are going to be equity investors. You're going to be lenders to a company. Right? You value the underlying company. You come up with 100 million. This company has debt outstanding. But the debt takes the form of 1 10-year zero coupon bond. In a while, you're going to see why I made that rigid assumption. But you guys have issued a 10-year zero coupon bond to me. I've raised the money from you. I've agreed to pay you 80 million, but in 10 years. Right now, the value of the firm is 100. If you liquidate the company today, you're going to liquidate for 100 million, pay off the 80 million, you're going to keep 20 million. Exercising this option today would be liquidating today. But you're not going to liquidate today. Why? Because you have 10 years to play the game, right? You don't owe the 80 million for the next 10 years. And over those 10 years, the value of the assets can go up and down. There's a standard deviation in the value of 40%. So that 100 million can become 180, it can drop to 40. Finally, to finish this picture, I'm going to tell you the risk-free rate is 10%. So I've given you the value of the firm. I've given you this zero coupon bond with a face value to maturity. And I've given you the T-bond rate. I'm going to argue with these 3 pieces of information. That's almost minimalist information. No cash flows, no beta, no cost of equity, no cost of capital. You should be able to tell me how much the equity in this company is worth. And you should also be able to tell me, if you're a lender, what interest rate you would charge me on my debt. Sounds mysterious, but here's how I'm going to do it. I'm going to treat it as an option. The value of the underlying asset here is the value of the firm, 100 million. That's the value right now. The strike price is what you'd have to pay if you liquidate, which is the face value of the debt, which is 80 million. The life of this option is the 10 years you get to play the game. Now, do you see why I made it a nice zero coupon bond? If it is a traditional coupon bond, what are you going to have to pay every 6 months? A coupon, which reduces your power, because if you don't make that coupon, the lenders take over your company. So if I introduce coupons, it doesn't change the story, it just makes it messier. I have a series of 6-month options. Here, I have a 10-year option. Over that period, my variance in firm value is 0.16, and the riskless rate is 10%. SKRT. There's no cost to waiting here, right? You're not losing any firm value while you're waiting. If I value it as an option, here's what the numbers come through. D1, D2, N of D1, N of D2. Remind me again, N of D2 is? There's a 63% chance that S will be greater than K. What's S here? The value of the assets. What's K? The outstanding debt. There's a 63% chance that I'll be able to pay, which means there's a 37% chance of what? What happens if the value of your assets is less than the outstanding debt? That you're bankrupt. There's a 37% chance of bankruptcy. There's this outfit on the Bay Area called KMV. And what they offer as a service, banks can go up to them with a loan portfolio, and KMV will estimate a probability of bankruptcy or probability of default on that. What they use is an option pricing model at its core. It's more sophisticated than the model that I'm using, but they use an option pricing model. They extract the ND2 and do 1 minus ND2 becomes the probability of failure. So in this case, there's a 37% chance that I will not be able to pay off the debt. But the value that I get for the call is 75.94 million. That is the value of your equity. You own the call option. Your equity is worth 75.94. I'm almost there. The value of the firm is 100 million, and the equity is worth 75.94. The debt is worth the difference, 24.06 million. But remember, it's a nice zero coupon bond. 80 million due in 10 years, you're paying 24.06 million now. I can solve for the interest rate, and the interest rate is 12.77%. Remember, the T-bond rate was 10%. The default spread in this company should be 2.77%. It's a paper I read about 3 years ago. I don't know whether it ever made it to publication, but the researchers actually used this model to estimate default spreads for companies and compare them to the default spreads you got by using an S&P or a Moody's rating. And at least according to this paper, they claimed they had a better shot, especially with highly indebted firms, of estimating what the default spread should be for these firms, using this approach instead of using a bond rating. So there's a 37% chance of failure. The value of the equity is worth 75.94 million. And the lender should be charging 12.77% as an interest rate on the debt. I'm going to use this example to kind of extract other lessons. But there are any questions about what the option is? It's an option to liquidate, and you have it as an equity investor, and you will use it if things collapse, right? Because you get to walk away. It's the limited liability that drives the value of the option. If I could come after your personal assets, the optionality disappears. In fact, one of the tricky things about how Musk is financing the Twitter deal, if it goes through, he's actually borrowing money, but he's not borrowing against the assets of the company yet. He's borrowing against his personal wealth, which is, because it's substantial, you can borrow a fair amount of money. That raises it because if you're thinking about Twitter as an option, you can't use that argument if it's going to be privately held and the loans have recourse against the rest of your assets. So here's the first what if that we're going to do. So remember, it's 75.94 million equity. So you feel pretty comfortable. You feel that it's fairly valued. You bought the stock. Tomorrow you wake up to some really bad news. Half the company has disappeared. Don't ask me how. You have 2 factories, one in California, one in Florida. Take your pick, hurricane or earthquake, but make it just one. Half your business is gone. It's not insured. So your $100 million value is now going to drop to 50 million. Is this good news? No, not unless you have a very perverse definition of good news. Clearly, this is bad for you as an equity investor. Before this happened, the value of your equity was 75.94 million. So I have a very simple question about the value of equity after this catastrophe. And here are the 3 choices. I could take the 50 million off the 75.94. After all, you've lost 50 million, and say your equity is going to be at 25.94 million. Or maybe it's going to be worth a little bit more than 25.94 million. And to complete the choices, it could be worth less. If you listen to your accountants, they're probably going to say it's worth nothing because the book value of equity turned negative. What do you think the right answer is? Should I knock off 50 million, less than 50 million, or more than 50 million? Clearly, you're losing all three. What do you think? Less than the 50 million, in which case somebody's got to bear the rest of the loss, right? So who's the only other player in this game? There are only 2 players in this game. They're the equity investors. Clearly, this is bad. Is this bad news for the lender as well? You still have the $80 million loan out there. The company is now worth half what it was yesterday. You're kind of stuck, right? And here's how you can see it. I went back and revalued the equity as an option. The only thing I had to change was the S. Instead of being 100 million, it's now 50 million. Everything else in the option stays the same, right? You still have the same loan. There's still the same 10 years to maturity. The still variance is 40%, because remember, variance is in the level. It's not on the dollar value. So even though your company's half the value, the variance stays the same. Here's what I got as my value for equity. 30.44 million. My equity value dropped, but it dropped by only 45.5 million. You're saying, what do you mean only? Well, the total loss is 50 million. My value dropped only 45.5 million. My lenders take the remaining 4.5 million. Remember, their debt was worth 24.06. It's dropped by 4.5 million. The 50 million has to go somewhere. But remember, the chance of failure was 37% before this happened. Notice what's happened to the chance of failure. ND2 is now 41.6%, which means the chance of failure has now gone from 37% to almost 58%. No surprises there. Half your company disappears. The chance you won't make it has gone up. Once I started on this process, I couldn't stop myself. Now I dropped it to 50, then I dropped to 40, then I dropped to 30. So basically I took the firm value and kept knocking it down. You know what the question I was trying to answer was? When does equity become worthless? Because you sometimes wonder about this, right? You look at the market, there's this basket case company, everybody, usually an airline. So why would anybody buy equity in this airline? And it kind of, the people continue to pay 50 cents, 75 cents, $1. And we think of those people as crazy, right? Discounted cash flow valuation is negative. The book value is negative. Well, the next graph might give you an answer to why equity hangs in there. Here's what I did. I knocked the value of the firm to 10. In fact, I knocked it down all the way down to 3 million. And equity still hung in there. So when I used the option pricing model, there was still a value. So I have a question. What's keeping the value of equity afloat? This is clearly a basket case company. You still owe 80 million. Your value of assets right now is only 3 million. Why would I ever pay for the equity in this company? What are the 2 things that are keeping it afloat? I'm sorry, what? Time, right? If the debt were due tomorrow, there would be no value. So I have 10 years. And what's the other ingredient? Hope. Time and hope that something good will happen. Then I go pray. You pray that something good will happen. Then you hope that something good, and maybe something good will happen. Most of the time, nothing good happens. And you throw the stock into the trash can. It's a deep, deep, deep out of the money. No, it gave, when I did this for the first time, it gave me an entirely new perspective on what bankruptcy meant. And actually, I got that perspective from my daughter when she was 3 years old. She actually turned 27 yesterday. No, she was a very precocious creature. Actually not, but we used to play Monopoly when she was 3 years old, and her two older brothers and I used to play Monopoly. She used to insist on joining it. Now, after about the second or third round, we had to ban her because she's like a one-person Android. She helped herself to, in Monopoly, you get $200 when you cross-go. She just took $200 every time she had a turn. So after the third time she did this, I said, Kendra, you're bad. And she walked around. She's a tiny creature, terrible, terrible temper. She walks around and says, you're bankrupt, you're bankrupt. I'm very impressed that a 3-year-old was using the word bankrupt. I said, Kendra, what does bankrupt mean? Expecting an answer like your assets are greater than your, or less than your outstanding. She said, bankrupt means you don't get to play the game anymore. You know what? It's a perfect definition of bankruptcy. Because as long as you get to play the game, you're not really bankrupt. There's 10 years left in this game. Something could happen that could keep the value. You've heard of vulture investing? Vulture investing is the subset of investing where people seek out the sickest of companies, not the healthiest of companies. It's very perverse. Sickest of companies, where everybody's convinced that these companies are basket cases. They buy equity in these companies. And let's say you buy equity in 50 of these companies. They do it with open eyes because on 45 to 50, guess what's going to happen to your equity? It's going to go to zero. But in the 5 out of 50, what you're hoping for is the optionality will save you, because on those 5, you're not getting 15% returns, you're making 9,000% returns. Airlines are a classic example. Continental Airlines, as it was called before United took it over, in 1993, it sold for $1 per share. Why? Because in its regular bouts with bankruptcy, the company was technically bankrupt. People were convinced it was going to crash and burn. They bought the stock for $1. 1 year later, it was trading at $53 per share. You will never get that with a healthy company, right? 5,200% returns. But it changes your perspective. So let me ask you a question. If you are, in fact, going to go down this path of buying equity in troubled companies, I'm going to go through a series of choices, and you tell me which of these choices you'll take. Do you want to buy equity in troubled, stable companies or troubled, risky companies? I don't even know what a troubled, stable company would look like, but it's a company that says, we lost 200 million last year. We can guarantee we can lose 200 million every year forever. Who wants that, right? So you want risky because risk is what's going to bail you out. You want to buy equity in troubled companies with long-term debt or short-term debt? You want longer-term debt over shorter-term debt. Essentially, it changes the way you think about investing because you're no longer buying shares for cash flows. You're buying them as options. Now let's use this option example to talk about another issue we run into. Now, let's suppose you have a company which has an asset value of 100. Now you come up with the value of equity and the debt. So back to the original example now, before the catastrophe. This company is offered a new project. I'm going to be the project salesman. I come into your office and say, do I have a project for you? And you ask me to describe the project. And somewhere along the way, I said it's a negative net present value of -2 million. You get ready to throw me out. Say, wait. Not only is it a bad project, it's a very bad, risky project. Sounds crazy, right? I'm going to argue that there will be times you as the equity investor will take that bad, risky project and walk out the winner on the other side. In fact, let's assume you go out and take this project, -2 million net present value. The day after you take the project, what's going to happen? The value of your business is going to go from 100 to 98, right? Net present values are added. This is bad. But it's a very risky project. It pushes up your standard deviation from 40% to 50%. So it goes. So what you've done is you've push down the value, you increase the risk in the firm. Let's see how the magic plays out. If you make those two changes, remember the value of equity was 75.94 before you did this? It increases to 77.7. It's almost magical. You went and took this bad project, it was a bad, risky project, and you come out of this process smelling like a rose with a higher value for equity. But who's losing? You've essentially transferred value from the lenders to yourself. This is ripping off your bondholders by taking a bad, risky project. You can see this coming. I'm always surprised when banks lend to people doing LBOs without enough strings attached. They act like, hey, they're going to do the right thing. They're going to do the right thing for themselves as equity investors. But if you're Bank of America and you've lent in an LBO, don't be surprised if what they do ends up enriching them and making you worse off. Which means if you're lending on an LBO, there are two things you need. One is you need an equity stake. You never should be lending on an LBO just because the interest rate looks good. And second, you need to be in that room when big decisions are made. You can't let the equity investors pick a board of directors and make decisions because they're going to watch out for themselves. It's a transfer of wealth that happens from it. We've talked about this in capital structure, how there are agency costs. This is agency costs playing out as numbers. One final example using this to kind of illustrate how this can give us some insight into what happens after acquisitions. The conventional wisdom on acquisitions is if you pay fair value, it's like taking a zero net present value investment. That if you're a company that goes out and does an acquisition, you value the company and you pay that price, it shouldn't hurt your equity investors. So let's say that's true. Let's assume that this company, the $100 million company that I described, decides to go out and do an acquisition. It buys a $150 million company for $150 million. So it's paying fair value. But that company comes with $50 million in debt and is in a very different business than your company. So think of this as conglomerate acquisition in practice. Saying, what does it matter? It's in a very different business. If you're in different businesses, the correlation between the businesses is low. Steel company buys a steel company, they tend to be highly correlated with each other. A steel company buys a technology company, there's a low correlation. How will this play out? If you look at the variance in the combined company's value, think of it as a two-asset portfolio that we start every portfolio theory class with. Remember, if you have two companies and they each have a standard deviation, and you're given a correlation, the variance in value of the combined company is actually going to be lower than the variances of the individual companies simply because of that covariance term. Trust me, I'm going to come back to the acquisition and talk about why this matters, but the variance I'm going to get for the combined company is 0.154, which is lower than the 0.16 you saw for the first company and the 0.25. So basically, I've taken two companies with variances that are higher and create a combined company with an even lower variance. That's a covariance plan. So if I recalculate the value of equity in the combined company, I'm going to be using this lower variance. Do you see why this is going to affect you as an equity investor? What happens to the value of your equity? Well, remember, as the variance drops off, the optionality becomes less. And here's what happens. You pay fair value for the company, you actually end up losing about $3 million in value after the acquisition, even though you paid fair value. And the reason you lose money is the lenders to the company actually walk away with the benefits. Because remember, their interest rates were set when you're two risky companies, you created a safe company. They're still getting the same interest rates, but it's now a safer company. This happens in every conglomerate. As you create the conglomerate, lenders are benefiting, but there's a way you can claw back the money. What are the two things you can do? If you're a company that's creating a conglomerate, you know this is going to happen. How do you claw back that gain in value from the lenders? What are the two things you can do? Yes. I'm sorry? You refinance it, use a lot more debt, right? In other words, if each of these companies could borrow 30%, use 40%. So one is, not only do you refinance at a higher rate, you use more debt. In fact, you hit both. You can go to the existing lenders and offer them a deal, which is, if you want us to keep the loan, well, you've got to settle for a lower rate. We're now a safer company. And if they refuse, you borrow fresh money at the lower rate, and people will be willing to because you're a safer company, and you refinance the debt. And if you can't get the refinancing, just go out and borrow more money because you now have excess debt capacity. That's another way in which you can essentially claw back the 3 million. Conglomerates that stay lightly levered as they grow will be transferring wealth from the equity investors to lenders. Just the sheer math works against you. One more reason why conglomerates might trade at a discount is you keep buying these companies and other businesses. It's not your equity investors who are benefiting, because I could have diversified myself. It's the lenders to these companies who are benefiting because they're now lending to a larger, more stable company at rates that they were charging riskier companies. Now, the examples I used were completely made up, right? The example I used, I gave you the value of the firm. I created this nice, neat firm with one 10-year zero coupon bond, came up with the standard deviation value. But if I said, can you apply this on valuing Singapore Air's equity, Singapore Air's distress? Let's think about the practical problems you're going to run into in applying this in practice. First, in troubled companies, you don't have just two claim holders. You have multiple claim holders, not just debt and equity. You have convertible debt and convertible preferred. That's going to create all kinds of issues. Second, with troubled companies, you almost never, in fact, let me take the almost out, you're never going to get one nice zero coupon bond because they borrowed from everybody who will lend the money. They have 50 different debt issues, some due in 2 years, some in 5, some in 10, some, and almost none of it is zero coupon. The third problem is that the value of the firm and the variance was given to you. How the heck do you get it for a regular company? That might be the least of our problems because this is, after all, a valuation class, so we could come up with those numbers. So let's try this. Right? For the value of the firm, here's what I'm going to do. I'm going to estimate, I could cheat and just take the market value of equity and market value of debt and say that. It's cheating because I'm then reverse engineering and coming up with new values for equity and debt. But if you're in a hurry, you can say, I know the market cap of the firm is 100 million, they have 900 million debt, I'll add the two numbers up. You can do a discounted cash flow valuation. In fact, many of you valuing troubled companies, if you look at your existing valuation, might already have the S for the model. It's the value of the firm. Or you can do a liquidation valuation. Remember, we talked about attaching a pricing. So getting the value of the firm is not going to be difficult. If it's a publicly traded company, if it's a private company, you might have to just use the DCF. For the variance in firm value, you got to do some gymnastics. Of course, if you did a Monte Carlo simulation, like I did for ExxonMobil, in addition to giving you a value for the firm, I can give you a standard deviation, but that's going to be a lot of work. So I'm going to make a suggestion. For those of you with troubled companies who are going to try to use the option pricing model to value the equity, it's like 1 in 7 companies. Here's what you can use as your standard deviation. Remember how I gave you bottom-up betas by sector? You can go to the sector and say, I also have bottom-up standard deviations with the sector. You have a troubled steel company, you can go look across and say steel company. And it's not rocket science. What I did was I used Capital IQ to get the standard deviation of every company, took the averages by sector. Use an industry average, move on. That's going to give you a sense of what the variance is. If you, once in a while, you might get a company with publicly traded stock and publicly traded bonds, and you can try to extract standard deviations on both and come up with it. And I'm going to show you how that worked. Really messy. It's not usually worth the effort, even if you have stocks and bonds trading in your company. So that's the variance. The value of the debt, in my example, there was one nice zero coupon bond, right? $80 million face value. In most real world examples, you're going to have 15, 20, 30 different debt issues. So here's what I would do. I would add up all of the debt outstanding. I would even add the interest due on that debt. Treat that as if it's one nice, gigantic zero coupon bond. It's cheating because that's not what it is. But I'm trying to make my life a little more malleable by taking all of the debt and saying, that's my K in the model. And now, since I'm on that path, the maturity of the debt is all over the place. I'm going to take a weighted average maturity. And if you want to get fancy, you can do weighted average durations because that's like a zero coupon bond. But I'm taking all this messy debt you have and replacing it with one nice zero coupon bond. So here's my example. You heard of Eurotunnel? It's this hole in the ground where cash goes in but never comes out. Originally, when the Eurotunnel was built, it's actually the tunnel that connects the UK to Europe. It was built on the expectation that the UK and France would end up making money off the tunnel. Never happened because it kept losing money. In fact, by the time I valued Eurotunnel in 1997, its earnings before interest and taxes were minus 56 million pounds, and its book value of equity was minus 685 million pounds. What does that tell you? They've lost money enough that they've driven their book value of equity to zero and kept going. The company also had an immense amount of debt. I'm sorry, book value of equity is minus 117 million. They had an immense amount of debt. And a lot of it was really long term. All of this is piling up, right? They're a troubled company. They're losing money. They have negative book equity. They have almost 9 billion pounds in debt. And the weighted maturity of the debt is about 11 years. So even though they have different kinds of debt, I've taken the weight. I did a discounted cash flow valuation of Eurotunnel. So I fixed them on my spreadsheet. I gave them healthy margins over time. But even with very upbeat assumptions, the value that I got for the firm on a DCF basis was 2.3 billion pounds. I have a problem. Do you see what it is? They owe 9 billion. And even assuming they come back to health, they're worth only 2.3 billion. In a DCF framework, if I ask you how much should you pay for the equity? Because I'm paying nothing. The value of equity is zero because the value of the firm is less than the outstanding debt. But before you go that route, it's worth noting that there's uncertainty. You have time as an ally, and you can hope that something good happens. So here, I did not look up the standard deviation based on other companies in the sector because there weren't any. Here I was kind of stuck. This is not like a steel company. At that time, there were very few infrastructure companies like Eurotunnel. So I took the standard deviation in equity value and the standard deviation in bonds traded by the company, both in stock prices. They were about 85% debt and 15% equity. This is, again, the two asset portfolio that we use when we have. So basically, I'm taking the stocks and the bonds and creating a portfolio. And the variance that I'm getting in firm value is 0.0335. I have everything I need. S is 2.3 billion pounds. The debt outstanding is 8. It's a deep, deep out of the money option. But the debt is really long term. 11.93 years becomes the T in the model. I've essentially taken Eurotunnel, a very messy company, and made it look like my hypothetical company. Let me cut to the chase, though. I do D1, D2, N of D1. What is the probability that Eurotunnel will default on its debt? N of D2 is 7.5%, right? That's a chance that they will make it, which means there's a 92.5% chance. I'm walking in with open eyes. This isn't some, upbeat assumption. I'm assuming they will fail 92.5% of the time. But here's the miracle. Even with that really dark story, the value for the equity is 122 million pounds. It's a basket case company with a huge amount of debt. But I'm buying this equity not because I expect dividends from the company, not because I expect cash flows. The only cash flows I'm going to see are big negative cash flows, but because there's time on my side and I'm hoping that something good will happen. So when you think about real options, remember there are lots of options. Everybody uses, even if they don't use the word option, they're using other strategic reasons. Just another argument for options. Most of these options don't have significant economic value, and relatively few of them can actually be priced using an option pricing model. So on Monday, we're going to talk about acquisition. So options are tricky. So go back and review the notes, kind of get a sense of what these option pricing models give you. Because they're also neat in terms of the information they provide about companies.